Valuations, Dan, they're often talked about after markets have already moved, and you talked about positioning portfolios to the bigger, stronger companies overseas and even domestically as well. How important are valuations in your portfolio decision making today? And are you finding any pockets of value at the moment with indexes around the world pretty much breaking all-time record highs or flirting around those record highs for so long?
Yeah, look, valuation is a key pillar in our asset allocation framework. So it's something that is monitored, it's discussed and reviewed constantly. But it's also important to note that earnings do matter more than valuations. And valuations are not a great short timing tool for the market, but they are critical for managing long-term risk and returns. And we know that markets can stay expensive or cheap for years or a very long time and be detached from the underlying fundamentals for a long period of time. But when you're looking at that longer term 5 or 10-year time frame, the starting valuation is key. It's very important. It's a good predictor of your future equity returns, your drawdown, your volatility. And that's because basically, if you think about it, your return from these investments is derived from three things: the earnings growth of the company, the dividends that you receive from the company, and the multiple that the company is valued, which is what goes up and down, which is what we call valuation. So if you pay too much, then your future multiple has to get lower based on fundamentals, and that will drag your returns down. And if you can get in on an attractive valuation, and what your portfolio is, how your portfolio is valued, does dedicate how the returns shape in the future. So this is why we monitor the valuations for every asset class to help us in our decision-making process. And in terms of the sectors that we're looking at, broadly speaking, on a global scale, valuations are elevated. They're very close to the 20-year peaks, but that's been the case for the last few years. So it's not a new thing. And as long as the earnings grow, then the valuations can be justified. At the moment, where we are seeing pockets of value are in emerging markets because of the recovery that we're seeing in that part of the world. We're seeing a relative value in global listed infrastructure and global listed real estate. There's two sectors that are actually not under threat by any way from AI in terms of their business model and their hard assets, and they've got some very steady, reliable growth within those businesses in those sectors. So those two sectors are sort of screening as relative value compared to the rest of the world. And I guess in the sort of the bond side of it, in the defensive side of the portfolio, the longer term government bond yields, potentially, particularly in Australia, where you can get a yield of between 4.8 and 5% for that highest credit quality investment, is screening as relatively attractive compared to what it had been in the past. So that's sort of four areas of the market that we see as attractive, and that's four areas of the market that we do have a slightly larger allocation to in our portfolios.